All right. Thank you very much for coming. This is Iain Hutchinson. I am a portfolio manager with the Kanata office of ScotiaMcLeod. And today what I've done is I've invited Gareth Watson, a CFA and a director of our portfolio advisory group, to discuss with us basically the outcomes and the future prospects within the Canadian marketplace. Gareth, as I had mentioned, holds a CFA designation and assists us in managing portfolios for our clients where we work on a one-on-one individualized relationship. Thank you for coming, Gareth.
My pleasure.
Basically what I was hoping from you was that you'd be able to give us a little bit of a discussion as to where we are in the Canadian marketplace and how we ended up getting here.
In terms of where we are presently, obviously it's been a difficult couple of years here in terms, especially 2008 with regards to market performance, in that we did see about a 35% decline that year, but we did rebound with a 31% appreciation last year for the Toronto Stock Exchange. So to say that things are at their absolute worst, certainly not the case. That was probably last March when the markets did reach their lows for this particular cycle. Within the stock market, things have been encouraging for Canada because of what we've seen from financial stocks and resource stocks. Obviously our weightings to those are quite high in Canada, and with our financial system managing to escape the financial crisis to a greater degree unscathed than our counterparts around the world, Canadian banks have been beneficiaries from that. So in terms of where we are from the market perspective, on a relative basis, we're actually in pretty good shape.
Now, we've seen quite a good, strong recovery from the bottom of the market. What we do have here is a copy of the presentation that you've delivered to us, and if anybody would like a copy of that, they can just contact our office and we'd be able to send out a copy right away. When we start to take a look at how the market had behaved in the last couple of quarters, we've seen a recovery of over 50%. But as you had pointed out, that recovery has been quite strong, but it's still far short of where we peaked a year and a half earlier.
That's right.
With that, is this sustainable?
I think the sustainability of the stock market returns are going to be dependent on what we see coming out of larger macroeconomic data. Markets do tend to be forward-looking, so in terms of where we price the market today, it's where we expect the economy to be 6 months from now. So it's a matter of whether or not the data follows through and basically either justifies where we put the market, i.e. the economic data is going to be good, or in fact we might hit some roadblocks that were unforeseen, in which case that's when you do start to see a bit of a sell-off and the market retrenches. I think over the next 6 months you could very well see some positive economic data out of the United States, because we have, it's estimated that since the end of the third quarter of 2009, we still had not yet seen about 70% of the stimulus spending in the United States enter the economy. Mm-hmm. And as such, that is expected to happen from the end of Q3 up until 6 months into 2010. So you're going to see a lot of economic data that reflects probably some very strong investment, but unfortunately, of course, that's not sustainable investment. Eventually the stimulus does die down. So in terms of the sustainability, it will depend on whether or not that spending flows through and is reflected within the broader economy. But more importantly, towards the end of 2010, a lot of people will start raising question marks as to whether or not the market and the economy can then start to operate on its own. So we could very well get off to a good start this year. Then when the doubters step in as to whether or not we can continue that, you could very well see either some flat performance or a bit of a retrenchment. And at the end of the day, it will be the economic data that we see at the end of the year that will tell us whether or not what we saw in 2009 is sustainable through 2010. So it really does depend on how the economy responds.
So with that kind of uncertainty in the market, it would probably uncover some opportunities within the marketplace. And if I were to come to you with a portfolio and I had some excess cash, and my overall concern was to generate income, I find a problem with the low interest rate environment now, that there isn't just the quality of investment to be able to satisfy my retirement income, for example. Would dividends be the safest place for me? And if so, where does Scotia feel that opportunities arise?
In terms of whether they're the safest place, of course, different companies vary in terms of the degree at which they could cut their dividends. Many, of course, you feel very safe with, in that you don't think they're ever going to cut their dividends. And there's some where, for example, if you're looking at an oil and gas royalty trust, it will depend on commodity prices as to whether or not those distributions are safe. And of course, with regards to income trust changing, of course, the going from being interested back into dividend producing names and the taxability implications because of that. are going to be factors. But yes, in terms of yields out there in fixed income product, there are certain opportunities in the equity market that can provide you with a higher, especially after tax yield. And that's why I think there's going to be a lot of focus over the next, and this is not just in the next year, with the demographics of our country, a lot of people are starting to retire, the baby boom generation, there is going to be higher demand for yielding equities and yielding product, high yielding product. And so I do believe people will turn to the stock market and turn to those sectors that tend to provide you with those yields. Those tend to be more defensive in nature, and of course people might stay away from that area because they think the economy is going to expand and they want to invest in cyclical names. But without a doubt, the yield and income opportunities are still there in defensives, and that's why we're not discouraging people from going into those areas.
Wonderful. One last series of questions that I would ask of you, and it's multiple, so
Right.
right between your eyes. My question is, where do we see the Canadian dollar? Where do we see the price of oil, interest rates, and again, fundamentally, how is the market environment going to be 12 months out from now?
Okay, so number one, currency. We see the Canadian dollar continuing to appreciate over the next year. Our economists at Scotia Capital believe that we'll probably get through parity on a sustainable basis by the second quarter of this year. Although currency traders are not slow and subtle people, it could happen sooner than that if they decide that that's where they want to take the dollar. But what you have to recognize is the fact that I think this Canadian dollar will stay through parity longer than we did the last time before. So there's going to be consequences for certain manufacturing areas of the economy and the economic recovery in Canada, quite frankly, with that strong currency. Interest rates, we are seeing forecasts from our economics department of probably 100 basis points worth of increases this year, all in the second half of the year for both Canada and the United States. The Bank of Canada and Federal Reserve, our economists believe, will have rates at about 1.25%, up from 0.25% on an overnight lending basis as of the end of the year. Oil prices, our research team is forecasting basically about where oil prices are today for the end of the year, which is about $78 a barrel. Come next year, they're not really increasing them that much either. They're going up to $80 a barrel. In terms of where we are today, probably a little bit ahead of ourselves on pricing based on fundamentals alone, excluding the impacts of the flow of funds in the market and speculation. And I believe I missed one more there. Just the fundamental outlook for the market at the end of the year, which, as I said, it does really depend more on what the economic data says south of the border, more so than north of the border here in Canada as to where we're going. Because, in terms of the U.S. economy, it is going to be a very influential factor for the global economy. It still is, and it's going to continue to be for some time, even though we're seeing increasing influence from emerging markets such as China. And so the fundamentals at this stage, when it comes to, for example, the U.S. consumer, the ability to get access to credit, the wealth effects of the past 2 years, and that particularly in home equity that has declined, the fundamentals do not support, I believe, a roaring recovery. And we haven't seen that. And I don't think people really do expect to see the types of recoveries that we've seen in the past, mainly because not only did we just have an economic recession, we had a financial crisis and a real estate crisis at the exact same time in the United States. Previous recessions didn't have all this other noise, if I can call it, which is extremely influential, happening all at the same time. So the recovery, while it is going to happen, is going to be, I think, a little bit more slower and subtle than what we've seen in previous recoveries. So the fundamentals don't support, let's say, us going back to 15,000 this year. That's not going to happen. And if it does happen, I'd be very concerned, because it shouldn't. But at the same time, I still think that the way our financials have been performing and the way that resource prices probably should be a year from now, that you could look at maybe high single digit to low single digit returns for the TSX.
Fantastic. Thank you very much. I do appreciate that. And as always, when we start to take a look at an individual's portfolios, we're not only looking at cash flows and demand for capital, we are looking from a tax advantage standpoint. So I appreciate the fact that you did touch on dividend income as well, because that's basically what we see in the future to be generating future cash flows and protecting you against inflation. This is Iain Hutchinson from Hutchinson Wealth Management, and thank you for your time.